Assalamualaikum. Hi everyone. How are you doing? So I will continue with the third part of this chapter. So we are still in chapter 6 on analyzing operating activities. Okay, so now let's continue with our next item. So for my kind reminder, you might to use your headphones or earphone for better audio quality. Okay, now let's start with the first slide on this part. So first of all, let's look at this standard MFRS 118 revenue, where this standard is the basic definition on the revenue. So I take some of the brief description about this standard, where it defines that revenue is the cost inflow of economic benefits during their period arising in the course of the activity. Those inflows will result in increasing equity. So this standard come from your MFRS 118. It does not belong to your textbook. It refers to your standard. So in terms of the measurement, revenue shall be measured at the fair value of the consideration received or receivable. Fair value is the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. Now let's focus on the textbook. You can refer to page 361. So as you can see in your slides, that revenues are defined in practice as inflows or other enhancements of assets of an entity or settlement of its liabilities, which is resulting from a company's ongoing major or successful operations. And if you say the total income of a company resulting from its main operating activities such as manufacturing, selling merchandise, and providing services. These recurring activities will increase in assets or decrease in liabilities on the company's books, whereby gains are increases in net assets or the equity resulting from peripheral or incidental transactions of a company. Come from the result from non-primary or incidental activity such as gains on disposal of fixed assets. So these are the guidelines for the revenue recognition. For our analysis perspective, inappropriate recognition of revenues and gains can have one of two undesirable consequences. Number one, if a company records revenue prematurely or belatedly, then revenue is assigned to the wrong period. Whereby, if a company records revenue prior to reasonable certainty of realization, then revenue might be recorded in one period and later cancelled or reversed in another. Meaning to say, it will overstate the income in the first period and understate it in the later period. So generally, revenue is recognized when it is both realized or realizable and earned. You can refer to Activity 6.8, which lists the criteria that must be satisfied for revenue recognition. For the specific standard, you may refer to MFRS 118, paragraph 14 to 19 for recognition of the sale of goods, paragraph 20 to 28 in terms of revenue of services, and for insurance, royalties, and dividends, you can refer to paragraph 29 to 34 in the same standard. So these are the transactions happens when you sell product to your customer. First, start with some introduction here, where the trading process complete. Then there will be an exchange transaction between the seller and the buyer, and then you will recognize the revenue. Now, let's look at the criteria in terms of revenue recognition. Number one, earning activities are substantially complete and no significant added effort is necessary. Risk of ownership is effectively passed to the buyer. Revenue and related expense are measured or estimated with accuracy. Revenue recognized normally yield an increase in cash, receivables, or securities. Revenue transactions are at arm's length with independent parties. And last one, transaction is not subject to cancellation. This one will be the guidelines for special situation. There are some special revenue recognition situations such as uncertainty in revenue collection, when revenue right of return exists, in terms of franchise revenues, revenue under contracts such as percentage of completion method or completed contract method, and unearned revenue. So I will explain later in detail in the next slide. First, in terms of uncertainty in revenue collection, you can refer to page 362. Company use a provision for doubtful accounts to reflect uncertainty in the collectability of receivable from bad sales. The company makes a judgment based on the circumstances when it can no longer reasonably assure that the collectability of the receivable. This judgment can be conservative, or it might use liberal or optimistic assumptions. When collectability is no longer reasonably assured, practice follows a general procedure to defer recognition of revenue until the cash is collected. Number 2 is when revenue right of return exists. Now, when the buyer has a right to return, revenue is recognized at the time of the sale only if the following conditions are met. Number 1, when the price is fixed at the sale date. Number 2, when the buyer paid the seller or obligated to pay the seller. 3, buyer's obligation to seller is unchanged if damage or theft in product. Number 4, when the seller has no significant obligation. And last one, the returns are estimated. So if these conditions are met, then the sales revenue and cost of sales are recorded but reduced to reflect estimated returns and related expenses. If not met, when the revenue recognition is postponed. So that's all for our part today. I will continue to the next final part in the next video. See you again. Bye. Assalamualaikum.